Jó reggelt kívánok mindenkinek. So, good morning for everyone. We will start soon this panel, and I think it was in the program that we will do it in English, since we have a great keynote speaker who is from the Národná banka, Slovakia. This is how we say in Slovakian. Slovenska, sorry. Slovenska. We don't really speak Slovakian. Reiner is speaking Slovakian, German, English, at least. So we chose the English version. But before I give the floor to Reiner, we will have a very brief introductory remark from the president of the chapter of monetary policy, Előd Takács, who is actually now in Basel at the BIS, because he's having the governor of the National Bank of South Korea. So the president of the National Bank of South Korea was the one who beat this program for him, unfortunately, but he will be with us on video.
Good morning, distinguished colleagues and valued participants. It is my great honor and privilege to welcome you all to today's session titled The Tale of Two Cities, Fighting the Post-Pandemic Inflation Surge Inside and Outside the Euro Area in Central and Eastern Europe. My name is Előd Takács, and I have the pleasure of addressing you as the president of the Monetary Policy section of the Hungarian Economic Association. This discussion is both timely and critical for three key reasons. First, the topic itself. Inflation is one of the most pressing economic challenges of our time. It affects every aspect of our economies, from the decision of central banks to the daily lives of households. Stable and low inflation is the cornerstone of sustainable economic growth, while high inflation, runaway price increases, can destabilize economies, disrupt livelihoods, and lead to political discontent. Understanding this issue is essential for fostering monetary stability and economic growth. Second, our geographical focus. Today, we turn our attention to the experiences of Central and Eastern Europe. For Hungarian economists, this is perhaps the most relevant comparator group, as CE countries share similar histories, economic challenges, and transitions from communist regimes to democracies and European Union membership. Moreover, examining the region provides us with valuable insights into the experiences of countries both inside and outside the euro area, shedding light on the key benefits and trade-offs of euro area membership. Finally, our distinguished speakers. We are fortunate to have with us some of the most renowned experts in the field of monetary policy. Among them are two central bank chief economists, Ádám Banai of the Magyar Nemzeti Bank and Reiner Martin of the Slovak National Bank. We also welcome György Szapáry, former deputy governor and senior advisor of the Magyar Nemzeti Bank, as well as Gergely Tardos, chief economist of OTP Bank. Their expertise and insights will undoubtedly enrich our understanding and spark meaningful discussions. While I deeply regret not being able to join you in person today due to work commitments in Basel, I want to express how much I value the opportunity to connect with you even from afar. I truly miss the in-person interactions, the chance to shake your hands, to hear your ideas, and to engage in those corridor conversations that often yield the most profound insights. Thank you all for being here and for your dedication to advancing our collective understanding of this vital topic. I am confident that today's session will be both insightful and inspiring. Without further ado, let us begin. Thank you.
As you probably know, when we started this chapter for the Economic Association, the goal was to put on table some international topics beside Hungarian ones, and we have the privilege to have here Reiner Martin, who is Executive Director of Research at the National Bank of Slovakia, and who wrote a very exciting paper with Mohácsi Piroska about central banking and fighting inflation in the CEE region. So we will hear this presentation from Reiner, and then we will talk about the topic with Gergely, Tardos and György Szapáry. And if we have time at the end, this small but enthusiastic audience will be able to have some questions from the speakers. So Reiner, the floor is yours.
Thank you very much, Adam, for the warm welcome, and good morning to all of you. So I heard this morning that I made a mistake yesterday. I came rather late to the city, around 10 o'clock, and then I assumed, being German by nationality, that by 10 o'clock dinner's over, everybody is back home and preparing for the next day. So apparently I missed the party until 3 o'clock in the morning. Okay, next year it will not happen in case I'm invited again. Right, so let's start with the topic of my speech this morning. So I would like to talk about inflation fighting within the monetary union and outside, the case of the Visegrad 4. And the Visegrad 4, as you all know, is of course Hungary, Slovakia, the Czech Republic, and Poland. And I should say that this is, as Adam already pointed out, this is joint work with my dear co-author, Piroska. So, why are we talking about this, or why did we decide to write a paper about this? Well, the recent high inflation period was terrible from many respects, right? It created a lot of hardship for many people. But from an economist's perspective, there is a silver lining in this. So in a way, it provided us with a natural experiment for monetary policy inside and outside the euro area. So why am I saying this? Well, if you look at the Visegrad 4 countries, there are 4 countries that share a lot of structural features. So all are post-transition economies, of course. All of them are sort of small to mid-sized economies, extremely open, extremely integrated into global value chains, but at the same time, they have very different monetary policy regimes. So you have on the one side Slovakia, which adopted the euro in 2009, so already quite some time ago. And then you have Hungary, Poland, and the Czech Republic with independent monetary policy, and also, I should add this, with flexible exchange rates. So some of the countries in the region, like Bulgaria, that will join the euro at the end of this year, they had a currency board, or they have different types of semi-flexible or inflexible exchange rate regimes. But these countries not, they're fully flexible, right? So this is very interesting, of course, to see how similar countries dealt with this external shock of the high inflation, and what did it mean for the effectiveness of monetary policy. So the main question or the main aim of the paper is really what the recent high inflation episode can tell us about the effectiveness and efficiency of monetary policy in the various V4 countries, Visegrad 4 countries. And I think this is an interesting time to discuss this, because this discussion has become a bit dormant over the last 10, 15 years. There was very little debate. There was a lot of debate 20 years ago, but then it's sort of stopped. It sort of subsided, really. And I think one of the reasons for this, ironically, is that there wasn't a lot of inflation over the last 10, 15 years. So there wasn't really very much to analyze and to discuss. So we would like, with this little paper, to contribute to an ongoing debate. And I should also add, we do not provide here any exhaustive analysis in detail about what happened in the V4 countries. We cannot do this from a Slovak perspective. We know, of course, a lot what happened in Slovakia, but I don't know all the details what happened in Hungary or the Czech Republic. And I should also say, if you are interested in this paper, It has been published in the Financial and Economic Review at the end of last year, so it's available, and you can look at this in more detail. Right, so let me then go to, first of all, the review of the literature. What does literature tell us about the impact of the euro on inflation? Not that much, interestingly enough. So even if you throw the net relatively widely, there is not a lot of literature that does this sort of comparison. So there's three strands you can look at. The first strand of literature is about the medium to long-term inflation effects. There are some studies, of course, but evidence is not super clear. Again, it's to my previous point. I think there just wasn't that much inflation to study. The second strand is about the one-off inflation effects of euro adoption. And this is a bit like a recurrent theme. So whenever a country adopts the euro, there are discussions. What did it imply? What was the inflation shock related to this? Now the findings are also very similar. So it's typically between half a percentage point and a percentage point. It's a one-off, it's transitory, so not really a big deal. But, and I should say this, from a political perspective, it often is a big deal. Because this shapes often the political discussions, saying, you know, since we have the euro, things got so expensive. So Italians still talk about how wonderfully cheap the espresso was in 1998. Huh? So just to give you an example. But if you look at the evidence, it's not there. And the third strand, this is about the impact of monetary integration on trade and growth. Well, there was some initial enthusiasm, the so-called endogenous optimum currency area theory, saying, well, if we have the euro, then there will be lots more integration, and this will be a big boost for growth. Well, you don't really see this. But is this a surprise? Not really, because the euro, the exchange rate regime, is more about economic management. It's not really a structural feature that gives you a long-term boost for growth. So structural reforms, institutional quality, and so on, that is much more important in this regard. Right, so much for the literature. So let me get then to the actual inflation performance. Now, inflation in the CEE, Central Eastern European countries, including also other countries in the region, has been very high, much higher than the euro area and EU average. So the euro area average peaked around 10% in 2022. This is also extremely high, of course. But in all the four V4 countries, it was way above that. So sometimes in this presentation we say Slovakia did best, but it's actually the least bad, I should say. Right? So inflation has been severe in all the four countries. Now Hungary had the highest inflation rate, it's above 25% in late 2022. But also in the other countries it's between 15 and 17%. And this is, of course, these are rates where no central banker can be happy about, right? And we were not. So the main reasons are that in the region here, in all the four countries, there are significant structural differences with the rest of the euro area and the Western and Southern, Northern European Union. So first, there's a high exposure to global shocks, so global supply chain disruptions, and the energy price shock after the Russian invasion of Ukraine. The region here was more severely hit than the rest of the euro area or European Union. That's the first reason. The second reason is that the share of energy and food in the consumption baskets in the countries here tends to be higher than in the rest of the euro area. And there is also an important role of domestic demand pressure. So this is, for example, due to lower competition in many markets, food markets often cited as an example, simply because the size of the country plays a role here. And also quite tight labor markets. So there's very adverse demographics, as you all know, and also the migration cannot provide much of a relief in these countries here. So these are structural features that are shared by all the V4 countries. So and that, of course, is irrespective of whether you have the euro or not. So some first chart here. Well, this gives you the headline inflation and the core inflation in the V4 countries. And as I said, it looks pretty bad. So does that work? Yeah. Okay. It doesn't work. Ah, yeah. Here, somehow it disappears. Okay. Anyway, so on the left-hand side, you see the headline inflation, and you see the red line here. This is Hungary, peaked above 25%. The other three countries were in the area around 15 to 17%. And then it dropped rather steeply, and now we're back to figures that are, of course, much more palatable again. If you look at core inflation, the picture is similar. So core inflation was also particularly high in Hungary, followed by the Czech Republic, and Poland and Slovakia. Also bad, but not quite as bad as the other two countries. So if you want to then decompose this a little bit, so what were the main drivers of this inflation performance? In this chart here, we look at four components. So one is the core inflation. So that's something that comes, for example, from labor market increases, labor cost increases and so on. We look at alcohol, tobacco, we look at energy, and we look at food and non-alcoholic drinks. And what you see in the chart is that the energy price shock after the Russian invasion, that was a key inflation driver across the V4 countries. And especially, of course, in Slovakia and Hungary due to the energy dependence on Russia. Right? So this is something you see very clearly. So food inflation also played a large role, again, particularly in Slovakia and Hungary. This is partly secondary effects of the energy price shock. It's partly also a result of bad weather. For example, there were bad harvests during this time. And again, also the competition issue plays a big role. And core inflation was especially high in Hungary, but it's also quite elevated in the Czech Republic and in Poland. And this is actually a little less, this was less the case in Slovakia. Probably because in our labor market it was not so much affected. So a little less than, so wage increases were a little less than in the other countries. Now, for Slovakia, and unfortunately only for Slovakia, this is another way to slice and dice the figures. So we do not have the model to do this for the other countries, so we did it only for Slovakia. So here we decompose inflation into three components. So one is called exogenous. And exogenous, this I should explain, because exogenous is not an exogenous shock. Exogenous in this case is actually like a steady state share of inflation, so something that you would always have. So maybe the labeling is not the most intuitive one. And you see, this is the gray part. That's been fairly stable. There was not a big change in this, right? Then you have the supply shocks, so that would be energy, food prices, and so on. And again, you see huge increase here, starting in 2022 Q1. Okay, and lastly, you have the demand shock. So demand shock would be a decline in demand from the population, and there you see a negative demand shock, so reducing inflation. In 2019, and then in particular 20, and then still in 2021. So what was that? COVID. So we had all the lockdowns that resulted in a loss of demand. So that had a downward impact on inflation. And then you had the lifting of the curfews, of the COVID measures, and you had a lot of fiscal support kicking in 2020, but then also 2021. And then you see the blue part here of the inflation component is reversing. So what you saw in 2022 is like a perfect storm. So you had a lot of external shocks, and you had a rebound of domestic demand at the same time. And of course, that is challenging for any monetary policy authority. This is very, very clear. And again, this is only for Slovakia, but I think it would probably look relatively similar for the other countries. So, what did the central banks do? Well, this chart here gives you the main policy rate in the euro area, which includes, of course, Slovakia, and the 3 other Visegrad countries. And this is, I think, a very, very interesting slide, because what you see is that the 3 Visegrad countries with independent monetary policy, they reacted a lot earlier. Really a lot, like a year before the ECB. So in the summer of 2021, the tightening, the hiking cycle starts almost at the same time, and the ECB kicks in only more or less a year later. Okay. The other interesting thing, and this is of course less good for the V3 countries, is that the policy rates were a lot higher than in the euro area. So you see here the rate in Hungary peaked and plateaued, I should say, at around 13% for quite some time. That's high. That's very, very high rate. And in the euro area, we had a peak policy rate of 4.25. So in Hungary, it's 3 times. That's a huge difference, right? And of course, if you think of this, policy rates have side effects, of course, on the economy. This is the idea. You want to dampen demand by raising the rates. So the sacrifice ratio associated with this kind of monetary policy is, of course, very, very high, right? So very good news for the V3 countries in terms of timing, not so good news in terms of the amount or the intensity of measures that is actually needed. So, so just to wrap that up, so Slovakia did not appear to suffer from the fact that the euro area, the ECB, raised rates a lot later and to a much lesser extent than in the other 3 countries. Inflation in Slovakia was also high, as I said, too high, but it was a little less high than in the other countries and a lot less than in Hungary, for example. So this is, of course, an important question. What's behind that? And what lesson can we draw from this? Well, there's a couple of reasons. So some of them we do not explore because we lack the data. Some of them are pretty obvious. So 3 main reasons we could identify, and we described this also in the paper. The first one is that there may be, this is the speculative one, there could be a better anchoring of inflation expectations in Slovakia given the euro area membership. I don't know whether this is true. If you look at it for Slovakia only, it looks pretty good, I have to say. It's fine. We can't compare it with the other V3 countries, though, because there's no survey that covers all the 4, which is comparable. So unfortunately, we couldn't really do that. Maybe Adam can say something about this. And then the second point is that obviously the monetary transmission seems to have been weaker. There's 2 points here. One, this was raised also by the IMF in its regional economic outlook. The financial conditions index in Central Eastern Europe, also Southeastern Europe, was tighter than in the EU average before 2021, but then it loosened faster and deeper. So that would, of course, result in more inflation. Okay? And the second point, and this is a very important point, is the fiscal policy action. So governments throughout the EU did a lot of fiscal action to compensate for the cost increases, first from COVID and then from energy prices and so on. So that may have weakened monetary transmission too. And also if you look at the lending rates, so these are the rates that households or companies need to actually pay when they go to the bank and said, I'd like to have a loan. Well, that looks interesting, in particular in Hungary, I should say. So maybe you remember the chart with the policy rate, which plateaued at 13% and was flat for quite some time. Well, if you look here at the lending rate to corporates in Hungary, that looks a lot more lively. So obviously the transmission was, let's say, a bit bumpy, right? And we can talk about what caused that. Whereas in Slovakia, for example, but also in Poland and the Czech Republic, it's more in sync with the policy rate developments. So not one-to-one, this you would not expect, of course, but more or less. And in the case of household purchases, so this is house purchases, this is mortgages, right? You have a similar development. So in Hungary, there was a steep decline quite early on. So the transmission was certainly far from perfect. Another important piece of the puzzle is what happened to exchange rates. And what you see here is the exchange rate developments of the national currencies vis-à-vis the euro. Now, in the case of Slovakia, obviously zero. We have the euro, so there is no exchange rate development. And that was actually helpful. This helped for Slovakia, without a doubt, because we did not import any inflation along these due to depreciation, for example. And also, and this is a more structural feature, we don't have to worry about exchange rate interventions. We don't need to have a huge level of reserves to intervene in the exchange rate if we deem developments not in line with what we want to see. So that's clearly helpful. Now in the V3 countries there was different developments. In the Czech Republic there was actually an appreciation, a slight appreciation, so that helped Slovak colleagues. In the case of Poland, of the forint and the zloty, there was a depreciation. That does not help, as the textbook would tell you, right? So that is something that adds to inflation. Now, I should also maybe say that the ECB policy towards the swap lines and repo lines that it granted to the V3 central banks were actually helpful because they reduced the exchange rate swings, fluctuations, at least to some extent. So this was a helpful action from the side of the ECB. But nevertheless, this depreciation plays a role. So fiscal policy clearly is a big one, plays a big role here. So the V4 countries all entered the pandemic with relatively comfortable fiscal positions, but then all of them increased their spending quite massively during the pandemic, and also later on with support to energy. So I want to skip this. I think that we have already a little bit above time. So let's look then at the overall policy mix during the 3 periods. That's a bit of the background that you also have to keep in mind if you want to assess monetary policy. So post-global financial crisis and pre-COVID, what you saw is that monetary and fiscal policy were counter-cyclical. And prudential policies, so supervisory capital requirements for banks, be it individual or systemic, tended to be tightened. So then this changed a lot. During the pandemic, all 3 policies became highly counter-cyclical, so very supportive for the economy, because we all expected a major recession. And then after the pandemic, it becomes quite interesting, because here you have now countervailing forces. So monetary policy tightened, as I showed you, with the rise in the policy rate. Fiscal policies remained loose. That complicated the task for people like Ádám and me, and many others who were involved, obviously. No major changes in macroprudential policy, so this remained more or less the same. But clearly the impact, or the opposing impact of fiscal policy against the working of monetary policy played a big role here. Let me conclude by saying just a few words on the topic of growth and convergence, because this is in the discussions about euro adoption, this is often also a topic that is raised. Well, will it help us to improve our convergence? I wouldn't count on that. If you look at this, so the V4 countries, they made remarkable progress towards real convergence. What does that mean, convergence? So moving towards the EU, euro area, average per capita income. You can define it in various ways, right? So in other words, they became a lot richer, simply said, right? And there's been also a lot of, a large EU accession bonus since 2004. This is also well documented, this is nothing new. But, and this is something that we see for a couple of years now, real convergence has practically stopped. So there is no longer much of a movement towards closing this convergence gap. And this holds actually for Slovakia and for Czech Republic, but unfortunately at different level. So Czech Republic is above the Slovak level per capita income. And also in Hungary and Poland it has slowed a lot. So there is a real and tangible danger of a middle income trap in the V4 countries, but the euro has not much to do with this, to be perfectly honest. And I would like to stress this, the euro is about macroeconomic management. It's not your ultimate boost to growth. This will not happen. So the whole growth literature will tell you that what is really matters here are different things. So the public and private investment, the quality of institutions, the quantity and quality of labor, these things matter. Structural reforms, right? So that's what you need to work towards. Whether you have the euro or not, on that regard, I think is relatively irrelevant. So let me come to the end, just a few conclusions, and then hopefully we'll have an interesting discussion. So, so the main conclusion that we would draw from the facts, and it's really more facts than a super deep analysis that we are doing here, that independent monetary policy in the Czech Republic, in Hungary, and in Poland did not appear to have enhanced monetary policy effectiveness to address inflationary pressure. And we didn't really know so much about this. It's, as I said, it's a sort of a test case, right? One of the first we had for many years. And again, this is not a criticism at the central banks, not at all. I think the CNB, the MNB, and the NBP, the V3, the central banks, they acted early on, earlier than the ECB. And they acted very decisively. They took a lot of action. So this is not the problem. Not a problem of inaction, not at all. The currency depreciation, by contrast, was not helpful, certainly for Hungary and Poland. And non-monetary policies, especially fiscal policy, were also not helpful. Say here they were not supportive. I would say they were actually not helpful. It's probably less politically correct, but more factually correct. And there's a few things that can still be investigated. The role of inflation expectations, central bank credibility, so that is maybe for the future, still to look at. But I would leave it here for now, and thank you very much for your attention and looking forward to the discussion.
Okay. So thank you very much, Reiner. It was very, very interesting, and we have the privilege to talk about this topic with two other very senior experts on the field. György Szapáry, who was in many, many different positions, so we don't really have time to talk about them all, but what is very important that he was deputy governor for the central bank for 12 years, and Gergely Tardos, who also started at the Central Bank of Hungary, right? Then moved to the OTP, and he is the head or chief economist of the OTP since I know the OTP bank, so for at least 20 years or so. And what we will do in the next an hour, we will talk about the Eurozone and out of the Eurozone for different countries in the region. But before, we will talk a little bit more generally about central banking and different regimes, especially since György, Szapáry and Balázs Bonnák had a very nice paper recently. It was published a few weeks ago or 3 months ago about the work of central banks and the basis of their success. And what was very interesting in the paper is that the independence of central banks was one of the key factors behind their success. So let me give the floor first for György to talk a little bit about this recent paper and the results. And he also brought some main charts of the paper, which are on the wall there.
Thank you very much. Welcome to this panel. The last sentence of Martin was that inflation expectations and central bank independence on impact on inflation has to be investigated. Well, actually, what we have done, we are a contribution of investigating that. What we looked at was the new member states, that's from Central and Eastern Europe, new member states, that's what we examined from 1990 to 2019. And the questions we asked ourselves at the beginning was that all these countries for more than 40 years were operated under the Soviet economic system, where the state dominated everything, including the prices, setting the prices. Trade was mostly among themselves, and the private sector had very little role. Then, when at the end of the Cold War, all these countries regained sovereignty and moved toward the private economy, capitalist private economy, and they had to make some judgments of how to operate, what should be the monetary policy framework. They had to decide on a number of things. One was, what type of exchange rate regime do you want? There were all sorts of exchange rate regime during the beginning of the period. Back to the Deutschmark, then back to the euro, then currency board, then inflation targeting with exchange rates with narrow band, larger bands, no bands, and even in each country over time it changed. So that was the one thing that they had to decide. The other thing they had to decide how to treat inflation, what to do with inflation. When do you accept? So countries accepted at different time inflation targeting. The third thing was that whether you want to introduce the euro as soon as possible, or you don't make a judgment at this one. And the fourth thing was that they had to decide on the role of the central bank. You had to have an independent central bank because that was a prerequisite of the EU accession. So what we looked at, these 4 drivers: exchange rate, inflation targeting, euro adoption, central bank independence, how they affected convergence, real convergence and nominal convergence, inflation. Why we did look at? Because at the very beginning, each member at that time said we want to converge to the developed countries. And I will show you here. Okay, this is nominal convergence. You can see that inflation converged, you know, so there are no problem with it. There was a convergence in inflation. Oh, this is real convergence. Now, what we looked at it, you can see there was a real convergence. Now, we do not look at how fast they did, who did faster, who did less fast. We just make the statement that there was real convergence and there was also nominal convergence. That's the most important thing. We had that, when we were thinking of why do we add a central bank to our analysis of the drivers of convergence. We had a central bank because we said, if a central bank is independent, that means that there is democracy, that rule of law prevails, that institutions are generally independent, and all this means that the confidence in the economy is fairly strong. And if the confidence in the credibility of monetary policy is strong, confidence in the economy goes, then investment goes, and then you can grow and converge, so to say. Now, what was the method? We did a linear regression model, was estimated between 1990 and 2019. Why did we go only to 2019? That's because some data were only available for 2019, but still it's a very long period. So now the findings, and this will be the next chart. Here you see the findings. Let me take my own slide. Here you can see that if you look at the real convergence, the central bank independence dominates the convergence, the real convergence, for the reasons that I just mentioned. Credibility, because if a central bank is credible and predictable, it anchors inflation expectations, which helps then, you know, also growth. Now, here are some numbers. The central bank independence contributed 5 percentage points to disinflation, as you can see it over there, and 2 percentage points to real GDP growth. As I said, for us also it was a surprise that central bank independence played such a big role. We had no preconception, just because we work at the central bank, we had no preconception, but we were also surprised. But that's what came out of the estimation. Now, euro adoption in itself had no demonstrable disinflation effect, and only marginal negative impact on real convergence. Now, why euro adoption? Why would euro adoption have, in our estimate, a little negative impact on growth? Because euro adoption meant that you had to reduce inflation to meet the Maastricht criteria. And if you reduce inflation to meet the Maastricht criteria, you have a trade-off, and then growth in that long period of time, then growth is affected negatively to some extent. No, this does not mean, however, that the strategy based on adoption of the euro as soon as possible is not positive over a long term. It means that it helped nominal convergence, that's for sure, because you had to meet the Maastricht criteria. And even though it had a little bit of a negative impact on real growth, but it was overwhelmed by the central bank independence, which you can see on the chart. So overall, you can say that euro adoption indirectly, via central bank independence, helped real convergence as well. Now, the conclusion. The conclusion is that it cannot be concluded ex post that any strategy was preferable. You cannot do that. Except that central bank independence is a very important factor. And that means that tinkering with central bank independence can create problems. So don't tinker with central bank independence. And now you can see that the Fed, what's going on. For the time being, it didn't have impact, because for the time being, it was just President Trump making statements, trying to fire one of the governors there, but it will end up in the Constitutional Court. But later on, it might have an effect. We will see. It's too early. So my conclusion from this, don't tinker a lot with central bank independence. Thank you for your attention.
Thank you very much. There is no better message for a central banker than hearing that central bank independence is important. And I swear that I had no influence on the results. But before turning to the topic of the euro in the region, I would ask Gergely to a little bit talk about broadly on different exchange rate regime, because in the OTP they have several good experiences in different countries out of not just the Eurozone but out of the EU with different regimes, from Albania to the latest is Uzbekistan, and I have to be honest, I have no clue about the exchange rate regime in Uzbekistan. I only know that they use the SOM. So all those who are watching this because of having some trade ideas from on the OTP stock, I have to disappoint them, because we agreed that we will talk about macro. But if you want to say anything about the OTP target price, feel free. But first, more about the exchange rate regimes on different countries.
Okay. Luckily, due to, let's say, compliance rules, we are not allowed to deal with OTP. Do you hear me? Is it? So with OTP performance and OTP share price. So let's turn our attention to exchange rate regimes. To be honest, for me, on the first slide, the conclusion that exchange rate regimes were not really important or let's say decisive for fighting inflation was initially a bit surprising, partly because we have a different scope. So as you mentioned, we have Albania among countries where we have subsidiaries, and I live in Hungary. And this is a too good example, maybe, so that exchange rate regimes matters. Because, so as you showed, Hungary had a permanently depreciating exchange rate, and maybe it has something to do with that we have a much higher inflation in the last few years, and our inflation peak was nearly 11 percentage point higher than the rest of, let's say, Central Eastern Europe, and we can even speak about the Balkans because usually the inflation peak was around 15% everywhere. Maybe a bit lower in Croatia and Slovenia, but that was the characteristic figure, and in Hungary we had a much higher figure. Where we have a much lower figure, that's Albania, where the inflation peak was only 8.5%. Since then, they are running below target inflation, and this is, of course, the natural consequence that the Albanian lek is going on a permanently appreciating trajectory. So just around this inflation shock, the Albanian lek appreciated by 20% against the euro. And this helped Albanian central bank to keep inflation well below the level of regional peers. And I know that, speaking about Albania, we let's say, lose the homogeneity of economic structures because it's a Mediterranean economy dominated by tourism and agriculture. But it makes sense to think over whether, so this is a small country with a weight of food in the inflation basket around above 30%. So usually you would say that these guys would have much higher inflation. But at the end, because of this appreciation, they had much lower. And maybe Mr. Szapáry also spoke about the pre-GFC events. And those days, Slovakia, the Czech Republic, and Poland led their exchange rate to appreciate by 6% on average in every year. And it had no negative consequence on growth. It had no negative consequence on industrial production and exports compared to Hungary. In Hungary, we had a flat exchange rate those days with some, let's say, depreciation around the GFC. But, and also we had many countries with fixed exchange rate regimes, and those days Serbia also let its exchange rate to depreciate. And those countries which had flat exchange rates, those have higher inflation than Slovakia, the Czech Republic, and Poland. And those who let it depreciate, those countries usually had even higher. So I would say that this is a very special, combination of events what we had since 2020. And maybe we were very close to the, let's say, to the eye of the storm because of the war and being really exposed to German product chain disruptions. So maybe that except of Hungary, inflation, except of Albania, you would have an inflation of 15%. Maybe that's natural. What is important that you show that the Czech korun appreciated a lot since then, and to be honest, if you check the inflation in the Czech Republic, they are still above their target, but they have the lowest inflation around, and they are close to their target. So I think that inflation, from an inflation point of view, exchange rate matters, but maybe you need a longer horizon. So that would be my not so short conclusion.
Thank you. So going back to the Eurozone, as we have the privilege to have a central banker from the Eurozone, my question would be, and you gave some ideas in the presentation, and also György gave some ideas in the presentation. How do you see the benefits of being in the Eurozone, especially before the pandemic? When I started in the central bank, the GFC started, and we used to use the term pre-GFC and post-GFC. Then we have to use the pre-COVID and post-COVID periods. So how do you see, from a convergence terms and macro stability terms, the cost benefits of being in the Eurozone, and noting that the Eurozone is a little bit broader concept than having an exchange rate regime, because it is also being part of the banking union. It's a stronger political tie within the zone than out of the zone. So broadly speaking, how do you see the cost and benefits for Slovakia?
Okay, well, let me briefly go back to the analysis that we just heard about nominal versus real convergence. And I think the case of Slovakia is interesting there, because I fully agree. I mean, the fact that Slovakia decided in around 2004-05 to adopt the euro as soon as possible speeded up the nominal convergence a lot. It has to be done. This is clear, and this shows also, I think, in this analysis. The real convergence, as I said, I think is mostly driven by other things. I liked very much the reference to central bank independence. I think that is very important, and so I can also echo here what our governor in Slovakia often says. That's very helpful that we are in the euro area, because the ECB is, by design, probably one of the, if not the most independent central bank that you can imagine. Even if you wanted to influence the ECB, how do you do it? It's not straightforward, right? You have 21 governors and 5 executive board members in the governing council. How do you influence a decision there? Not easy. So I think this independence is very much enshrined, of course, in the legal treaty of the European Union. And it's also de facto there by design. So I think that is a huge benefit that we have from euro adoption. When it comes to other things, yes, I mean, the exchange rate stability with our main trading partner, I would not underestimate that. I also mentioned already that the fact we don't have to manage our exchange rate regime, keep this within boundaries that we like, and so on. So all of this is gone. We don't need to deal with that. That is very helpful. It also reduces, of course, the costs that we are having as a central bank. Does it help us for real convergence? Not necessarily. I mean, we actually, Hungary and Slovakia often compete, for example, for direct investments. So big companies come to the region, they say, okay, we want to set up a big firm here for cars or batteries or God knows what. They look at a zillion of factors. When we speak to these people, they usually tell us, it's nice that you have the euro, nice, add-on, but really what matters is the quality of the infrastructure, the quality of the workforce, availability of the work. That matters a lot more. So I would not overestimate the impact that it has on real convergence, either way, also not the other way. But I think when it comes to managing macroeconomic crises, as we have seen now with the inflation shock, there it's very helpful. And the experience that we have now since 2009 with the euro is a very positive one.
What I would like to add is that you looked at, and also, you looked at the role of the exchange rate for a short period of time, since the GFC. You have to look at a long period of time. That's what we wanted to do. From 90 to 19, it's 29 years. That there you can make a judgment. Now, there has been a lot of studies on the role of the exchange rate regime on growth. And some people looked at very long periods, some people at shorter period, developed countries, developing countries, many. And some of them said there is a positive impact. Some of the studies showed there is no impact at all. And finally, not very long ago, maybe a couple of years, no, a year ago, Andy Rose is a professor at Berkeley, and this must be his son. They wrote very nicely when they said that no obvious differences between exchange rate regimes were found in the literature. That's it. So now, in our case, I mean, in the CE countries, there is, of course, the possibility, on top of it, the obligation to enter the euro. And then, you see whether euro is good or bad. Some cases you could show that it added to. Well, you cannot even argue that it added to the growth as such. But you can argue that it's easier to deal with crisis for a small open economy because it will not be attacked so easily. That's for sure an advantage. So what I always have done or said was that you can have good and bad policies within and without the Eurozone. If you have bad policies, it's better if you're outside because it's better for the Eurozone, and who knows, maybe you can better manage a crisis. I don't think so, but it's certainly better for the Eurozone. But it cannot be a policy that you want to have bad policies. You want to have good policies. If you have good policies, I mean fiscal, etc., all the rest, reforms, then it's for a small open economy, it's better to be within the Eurozone. That's the only thing that I can say. However, you have countries that follow, EU countries that follow very good policies, like Denmark, and they are not in the Eurozone. They wanted to get there, but they had a referendum and didn't want to go there. There is Sweden, who is, okay, that's a little bit more difficulties recently, but they are not in the Eurozone. They also wanted to get in, but a referendum also turned it down. So that's my conclusion on the on adoption of the euro, and I don't know what Poland, the Czech Republic, and Hungary will do on that. Thank you.
Thank you. Turning to Gergely, we heard that probably it doesn't help in convergence, but the question is whether it hinders convergence if you are in the Eurozone. So how do you see this question?
Well, just one step behind. So maybe the Czech Republic and Switzerland does not really share the view that it's better to be within. I think what's very important that good and bad policies. So the exchange rate or having an independent monetary policy is the best shock absorbing tool for a country. But if you have bad policies, actually you are generating shocks instead of absorbing them. We know this well in Hungary. In that case, maybe it's better to give it up. And if you look and to use your monetary independence, you need wisdom and you need luck. If you check who entered the Eurozone recently, they were all countries heavily Euroized everywhere in savings, payments, and so on. So for them it was clear cut that they should join the Eurozone. And what I think that maybe you can find some negligible effect on convergence effect, but policies are much more important. So I think that the economy can adjust itself to monetary regime, but it's not easy to adjust to bad policies.
Turning a little bit to the banking sector, because Eurozone is also meaning to be part of the banking union. How do you see the roles of the central banks in the banking sector, in policy making at the banking sector, within or out of the Eurozone?
Okay, before going to this, let me just briefly say, I think one of the main messages of the study that I presented is that I think it raises some doubts whether independent monetary policy is actually such a good shock absorber. And this is also in the literature. I mean, you see that there is a difference between legal monetary autonomy and de facto monetary autonomy. And if you are a small, highly integrated, highly open economy, I really doubt. So I would put a bit of a question mark on that. But I very much agree, of course, that the quality of the policies matter. This is beyond a doubt. So coming back to Adam's point on banking, well, I mean, this is an area where the euro area has matured a lot. We started without any centralized supervision. That was a mistake, as we know, since the euro area sovereign debt crisis, where the problems in some countries came from deficiencies in banking supervision. And as you know, then as a result of this, the single supervisory mechanism was set up in 2014. So now we have a situation where microprudential, a bank-specific supervision, is not fully centralized, but it's highly centralized. So for the large banks in the systemic institutions, it's mostly centralized by being at the SSM, which is part of the ECB. For the many thousands of small banks, the national central banks still have, or the supervisory authorities, the difference from country to country, they still have some degree of autonomy, of course, and I think this is good. When it comes to macroprudential, so systemic supervision, the result is the reverse. So there is some degree of coordination across the EU and euro area, but ultimately the power for macroprudential policy is still with the national authorities. And I think this is good, because it's one way how countries can deal with differences in their economic cycles. And for example, in Slovakia, we were one of the most active users of macroprudential policy over the last 10, 15 years, and that helped us. So to some extent, it's a bit of a compensation that you lose this monetary autonomy, right? There's always trade-offs, of course, and you can partly compensate this with the use of macroprudential policy.
So you said that within the Eurozone, if you are in the Eurozone, no crisis. Think of Greece. Greece had a huge crisis in the Eurozone because the debt was high, the inflation was high, they lost the competitiveness, and the balance of payments deficit was very big, and suddenly people, even the local people, got worried what will happen, and they transferred their money out of the Greek banks to abroad because they said it's safer to be in a bank abroad. And it was a huge crisis, huge crisis. That's when Draghi said, whatever it takes, we will not let Greece to drop out from the Eurozone. But then look at Spain and Portugal. They needed help. You know, that's what when they established the European stability mechanism, that they could give money to countries that Eurozone countries that have a problem, because for a very long time it was thought that within the Eurozone, between countries, the balance of payment deficit don't matter. Until it turned out that countries like Spain and Ireland had a very large current account deficit because they lost competitiveness, and then the banks withdrew the money from those countries because they did not know what will happen, you know. So crises can happen within the Eurozone as well. Now that we have learned that, So, and as a result of that, that's a GFC, as a result of that, the European Central Bank introduced the supervision of the most important countries, you know, together with the National Supervisory Board. So that helps a little bit. What is still a big issue, that there is no capital union, capital market union. That's a big issue. I don't want to say about, but let me come back to the role of the central bank for one second. The communication of the central bank is very important. How you communicate, that drives or anchors the inflation expectations. And studies have shown that communication of numbers, it's not good, because if the number is not achieved, you say 5% rate of growth, or 2% inflation is higher, growth is lower, then credibility of the central bank is lost. So the research has shown that quality verbal communication is better. In other words, talk is better than numbers. That's the conclusion. And if you take Hungary, for instance, why didn't inflation expectation decline more or in line with what we wanted? Because regularly in the past few years, the outcomes were lower than the numbers that the central bank said, or the government, the central bank said. No, the growth was lower, the inflation was higher. Now people say, you say a number, it will not happen. If you say the inflation will be 4, no, they don't think so. So the idea is that quality communication without numbers is probably better to anchor inflation expectations.
Maybe I was misunderstood. I never thought that within the Eurozone no crisis could happen. Actually, what we could see, that's absolutely the opposite. Nevertheless, this was solved before the GFC, when the euro was much more, let's say, attractive. After the Greek crisis, the attractiveness of the euro significantly decreased, I'm afraid. But maybe there will be a comeback soon, take into account that most of the problems was maybe not solved, but have been mitigated. So now I think that maybe for Hungary the attractiveness of the Eurozone would be, let's say, higher or better.
So maybe there will be a comeback. So that then I would talk about a little bit about the future, since what we are, what we see now, not just in the Eurozone but in the region, is that inflation in the region is higher than the average of the Eurozone or the European Union, within the Eurozone and out of the Eurozone. And for sure, it is kind of the first test of the region in the Eurozone, because after the global financial crisis, we had a very low inflation environment, which was good for all the countries in Europe. But now there is a divergence between countries in the Eurozone. And what we see is that, for example, I think in Slovakia, the inflation figure was around 4%. And interest rate is 2% in the euro. And the question is, for the ECB, what we hear in the news is whether to cut further or not. So the question is not raising the interest rate, but cutting the interest rate. On the other hand, for example, in Hungary, we can keep a positive real interest rate to turn the inflation down. So taking into account the most recent periods and the crisis management, how do you see the Eurozone, and what is your biggest concern regarding the Slovakian processes, especially the inflation?
Okay. I would say that in Slovakia, the biggest issue that we face at the moment is fiscal policy. So that is the biggest concern. We have a relatively large deficit. Not so clear how this will change. And of course, throughout the region, we have the problems that, as I said, there's a structural problem of the middle income gap. There is also a cyclical problem. We have now the turmoil in trade developments with the tariffs from the US, with the slowdown in Germany, which is a bit the anchor economy, of course, for the whole region. So there is also a growth issue. On inflation, to be honest, I wouldn't be too worried. It is a little bit higher, but a lot of that is due to one-off effects still. And as I said, and I hope as I also showed to you, I think we managed to get through the very high inflation period with relatively low interest rates, and that is a good thing. It is a much better thing if you manage to deal with a policy rate of 6% rather than 15%, and there's no doubt about that. So from that perspective, I think the euro served us very well. And maybe just one word on institutional developments in the euro area. I think as far as the banking sector is concerned, the SSM is a huge step forward. And I think the SSM would go a long way to prevent the crisis that we've seen, for example, in Cyprus or in Ireland. And if you look at the shape of the euro area banking sector, it's pretty good, despite all the challenges we had with the pandemic, with the Russian war and the energy price shock. The banking sector is in good shape. Where I would very much agree, but I think this is an EU issue, is that we need a capital markets union. Definitely, this is a big issue, that we do not have this. The euro area tries to support this, but it's mostly about regulation at the EU level. So everybody is on board on this, including also Hungary and other countries that don't have the euro yet.
Gergely, how do you see the chances to get back within or out of the eurozone for the target of inflation? For the region, for sure.
For the region, well, I think it will be pretty challenging. Take into account that we expect growth to get more traction. Labor market are really tight. Wage growth is elevated everywhere. And globally we are entering a period where simply the disinflation effect of globalization won't be there. Instead of that, we will see trade fragmentation, much higher chances of drastic external supply shocks. So, how to say, I think this will be pretty challenging. On the short run, maybe we will see some more disinflation in most economies. According at least to forecasts, but you know, many forecasts went wrong recently. So I really hope that inflation will moderate, but how to say, there are many factors which cast some shadow on these expectations. So, for example, in Hungary, what we can see is that we will have an election year. We will have even higher wage growth next year. So fiscal policy will turn supportive, adding to domestic demand, and maybe we will have stronger growth and even more pressure on the labor market. So all in all, everyone expects, except of us, inflation to moderate next year. However, I mean, except of OTP research, but everyone make a lot of, let's say, side notes that if some things happen, maybe this not will be the case.
Yes.
Yeah. I think the biggest problem right now of the Eurozone is the large debt. France has 120% of that. Germany has more than 100%. I mean, you have never seen that, except during the war period. And you can see, particularly, you can see the borrowing rates abroad for the government is increasing, and the spread between the French and the German is increased, because the German has on top of it, the Germans have a political problems, political instability, looks like, etc. So that means that if the government borrowing is a little bit higher than all the private sector, it's even higher, you know. So that's an issue, and that can over time increase inflation, because at one point the governments will try to, at least in the first step, they will try to somehow reduce fiscal policy, trying to reduce the debt, that in the process, at least at the beginning, what they will do is they will be just borrowing more. Not from the central bank, but, you know, from abroad. And that can put pressure on within the Eurozone, the ECB as well, how they can then handle that. So that's what I'm thinking, a big issue. Now on the capital market union, I'm very much for it, because I thought, you know, capital market union can be done easily, because the voters are not interested in that. So it's not something like a fiscal reducing the fiscal deficit, etc. They do care about that, because, you know, they are interested in getting more social benefits, etc. But, you know, capital markets, voters are not interested. They don't even know what it is. So I thought that can be done very fast. But I was wrong, because each country is interested in their own capital market. They ask their banks to buy, the French banks, Italian banks, buy domestic government paper. You know, the home bias is very big. And of course, regulations are different. They could change that, but they don't want to change it because they want to keep it. They want to keep the home bias, you know. And right now, I am rather pessimistic that it will happen soon. What's your take on that?
Now, unfortunately, I'm also not super optimistic. I think there is two things here. One is indeed the political issues. On there, I'm more optimistic now, because I think there's a general awareness among the politicians that this would be helpful, also to finance all of these investments that are in the pipeline. So I think the political resistance, which I agree with you, was there for many years. I think that's less. The problem that I see more is that so a colleague of mine said, well, how can we have capital markets union if we don't have enough capitalists? And to some extent, he was right. I mean, what are people in Europe doing with their money? They build a house, and the rest they put on the savings account. Well, you need to have a change in this behavior. Otherwise, you will not get a capital market that is thriving like in the US. Now, governments can do a lot about this. So, for example, strengthening private pension funds. I think that would be important. Facilitating securitization. Maybe we even need something like Fannie Mae and Freddie Mac. I don't know. There are things that can be done, but also a cultural change is needed. And we all know cultural changes are difficult. It's not easy. Yeah, so I think this is a challenge, but if we can overcome it, I think it would be good. And a final word on this, when you talk to market participants, for example, many of them are quite spooked about what's happening in the US at the moment. And there is many large investment funds that would actually happily move money out of the US into the European market, what is the main problem they have? A lack of assets. There's simply not enough assets that you can invest in Europe. And if we manage to change that, I think that would be very, very beneficial for us.
Yes, this is why it is very important that there is some initiatives towards a kind of saving union by the European Commission, because I totally agree. I think the channeling of European savings to the US is bigger than to other European countries. So my fear would be bigger on this regard than within the UN in the capital market union. We are close to the end of this session, so I would ask the audience whether they have any question to any of our speakers.
So, is it working? Okay. So you mentioned earlier in your presentation that after the introduction of the euro, the inflation impact was not that high, but the population experienced much higher inflation. So do you have the reasons behind that, and how can that be managed from the central bank perspective?
The first part is easy of this question. The second part is not. The first part, it has to do with, so it's about perceived inflation, right? And typically you perceive more inflation if it's something that you have in your daily life. So I think I gave the example of the espresso that you drink every day, at least if you're in Italy. And then if that increases, you will notice. If the price for your washing machine doesn't increase, you will probably not notice that because you don't buy it very often. So that's the reason why in the political discussion, this plays a bigger role than it should, factually speaking. What to do about this? It's hard. I think actually the central banks in those countries that adopted the euro, like Slovakia at the time, now most recently Croatia or also Bulgaria, they are trying their best. There are legal rules that prohibit price increases as a result of the changeover. There is a lot of communication. I think the success is limited, to be quite honest. But of course, one should just keep trying. And I think your point also, don't communicate too much on individual numbers, but make it a general point. And also maybe refer to previous example. Maybe that helps. So you can ask somebody from Bulgaria next year how it went. Thank you.
Thank you. Any others? Then if not, I would very briefly conclude. My conclusion was, and for sure it's not objective, but I think it is a good message that not the exchange rate regime or in itself, or even not the membership of the Eurozone matters. What matters really is building up a good policy framework for the whole economic policy. So even in or out, we cannot skip this period to build up a prudent working policy framework which is with good independent institutions. So I think it is a good target and a good message for also for us in Hungary, because after that probably the convergence will be guaranteed in or out of the Eurozone as well. Thank you very much for taking the time to spend with us in this morning. I hope you enjoyed. I hope many of others will see it in YouTube, because I'm pretty sure that it is very important for the Hungarian economic life to put together experts, not just from Hungary, but from other parts of the EU and within the region. So I'm very grateful to Reiner to join us this morning, coming from Frankfurt by car. So I hope we can continue the discussion at one point. So thanks a lot, and have a good day forward.